Will a rate cut in September be enough to keep this rally going? Let's bring in Paulson Perspectives author Jim Paulson and CFRA Research Chief Investment Strategist Sam Stovall. Guys, welcome. Jim, you say these numbers tell us inflation isn't so much of a problem. We were just asking a guest earlier about pressure on the working class consumer, though. Is a Fed rate cut still a game changer if we see more signs of pressure through the rest of the year?
Well, I think, certainly you can make a case that if inflation stays bad enough or gets worse, John, then the Fed's going to be on hold. But, boy, I think the data we've had over the last few months and even today, to me, tell me that there's not a big inflation problem. The bigger problem right now is lack of real growth. Real GDP through the first half of this year is up a little less than 1% annualized. Job creation's up 60 basis points annualized. We got inflation that's running 2.5 to 3. That to me seems like much less of a problem than addressing the growth problem. And I think the Fed will opt to ease. I think that's what the choice they're going to make here next month.
Sure, yeah, sure looks like it. Sam, what extra information are we going to get from the producer price index, backing up a little further in the chain here? Usually it's not as interesting as CPI, but given that we're watching the potential impact of tariffs here, is it a little different this time?
Well, I think it possibly is, and also a hello to Jim. Haven't seen him in a while. I would tend to say that a lot of people look to the PPI as an early warning signal, if you will, for the CPI. And when we get those numbers on Thursday, expectations are that on a month-to-month and year-over-year basis for both core and headline are likely to be a little bit hotter than the prior months. So going into today's reading, I think a lot of people had been negative on the market in general and small caps in particular, and they had to reverse course today. We'll see whether we have to do the same on Thursday.
Okay. Jim, I'm looking at your notes, and there's a stat here that really jumps out to me. You say, excluding the 3 months last year when the Fed cut rates, that this is the only bull market in post-war history when the Fed has tightened throughout the bull. So if we get those cuts starting as soon as next month, what does that mean in terms of this market melt-up that we're already seeing a hint at today? And what does it mean you should be owning? Is it still Mag 7 or is it something else?
Yeah, Morgan, I think the reason the market has been so narrow in this bull market is because of the fact that the Fed's been tightening throughout the whole thing. Even though inflation's been coming down, and even though real GDP growth's been weakening the whole bull, they've still maintained a tightening force. That just hasn't happened before. They've left a lot of potential supports on the shelf that we normally get. If the Fed cuts the funds rate, it won't just be the funds rate coming down. When they cut that thing, long-term bond yields can come down. The mortgage rate can come down. The dollar will weaken further. The money supply will pick up. These are all positive forces for stocks and for the economy that we just haven't had yet. And so I think if they cut, it's a game changer. It's kind of like starting a new bull. I realize markets are high, but we don't generally have this much stimulus this late. I don't expect Mag 7 and tech to collapse because I think there's good fundamentals there. But I think they do underperform, and this leadership broadens out to small caps, international value plays in a bigger way, like the start of a new bull. The last time the Fed eased, really, was 2021, and small caps led. And I think that's what we'll get again if we get a change and finally get Fed support here for this bull.
What say you, Sam? How do you position yourself ahead of that?
Well, I think that small caps and mid caps offer a very attractive relative PE discount. Both are trading at more than 30% discounts to their average 20-year relative PE with the S&P 500. And normally what we find 12 months after the Fed has started to cut interest rates is a gain for large caps of less than 4%, yet this time they're up more than 14%, whereas the small caps are definite laggards, up about 3%. So an awful lot of room to move for the small caps given the opportunity.